I want to start with the question that, in a sense, Katie posed at the end of the last segment. We're looking at volume that has dropped sharply from the last 20 or 30 days, but even over the last 100 days. And I'm wondering to what extent uncertainty and confusion leads to inactivity from investors.
Well, certainly there's a high degree of uncertainty. Largely that's around the policy of the exact nature of the tariff and the likelihood or not whether there'll be a recession. And our economists here ascribe around a 45% probability of recession in the next 12 months. So the base case is, in fact, not a recession. The economy continues to grow. And so, Matt, the way we think about it is from a market pricing perspective. The equity market is pricing as though the economy is going to grow around 1.5%. That's right now. We make that conclusion based on looking at the relative performance of cyclical stocks, long, short, defensive stocks. Cyclicals versus defensives, that's correlated or scored relative to the GDP growth environment. And that would suggest the economy, the equity market right now is pricing as though the economy is growing 1.5%. That's a little bit above where the Goldman Sachs economists think the baseline growth is. And it certainly is not pricing in the risk of recession. And so all of the conversations we have, of which we have many each day with CEOs and chief financial officers of different companies, are about how do they signal the guidance? Should they be withdrawing guidance for the quarter, for the year? Should they widen the range? How does one think about giving guidance to the investor community? So there's a lot of uncertainty for obvious reasons, and that's reflected, I think, in the performance of the market right now, which is stabilizing these levels.
Well, David, I want to talk about how technical factors such as liquidity factor in, because actually the Goldman Sachs Prime Desk said last week on Wednesday, top of book liquidity on the S&P 500 futures was near all-time lows heading into the crash up that you saw on Wednesday. I know that you recently said in a note that liquidity has deteriorated pretty sharply over the last couple weeks. And when you think about the sort of negative feedback loop that creates with volatility, what actually breaks the cycle? What brings more liquidity into the market?
Well, the reason for there's several reasons for low liquidity. One of which is the uncertainty around what's taking place, and one of the consequences of a less liquid market is more volatility in either direction. Doesn't take necessarily dramatic changes in sentiment to have price action it's pretty dramatic, and you saw that, of course, last week in sort of spectacular fashion. What would provide a environment for getting more liquidity would be some clarity on the policy front, and that would give confidence. Right now, we've seen big de-risking, if you will, on the part of a large swath of the hedge fund community. The retail investors have been relatively more confident in putting money into the market. So we think about the risks, looking at what are the shares that investors are selling? Well, they sell, in fact, all of the shares that are more liquid. And so that is one opportunity. We look at the performance of companies with high liquidity relative to low liquidity. I think the bigger issue that investors really are focusing on is what is the growth prospects for the coming year? We're looking around 3% earnings growth. So if there was more confidence that you could have a better trajectory of corporate profits, that would be one reason for money to come into the equity market. That's kind of how we think about it.
Let's break that down a little bit more, David, because if you have investors that are so concerned that growth can slow meaningfully, if not turn negative, and the stocks are not yet all reflecting even where your projections might be from your team over there, why? What is it that's going to stall growth, and what are the indicators that you're looking for that would turn this tide around?
Well, what are the indicators for stall growth? Certainly with the labor market. That's the principal issue. If we see that some stabilization, continued growth, we're not really seeing in the macroeconomic data that things are deteriorating. There's more of a concern around some of the sentiment indicators, which would suggest some reasons for concern. I think there's a question about what's the state of the consumer. So we think about the labor market, state of the consumer. We'll obviously get more of an update in the next couple of weeks with the earnings, but of course earnings are really a function of backward-looking results for the first quarter, which is why the conversations with managements right now we're having are all about the guidance and how do they want to message that information, their perspective on what's happening in the coming year. So give you an example, right? You have usually around 20% or so of companies provide guidance in the coming quarter, the next quarter. And about 40% of companies or so offer guidance for the full year. So is a management team likely to give guidance in the current quarter? They want to withdraw that because of the near-term uncertainty. They want to continue to maintain their guidance for the full year, for example, because they have a long-term strategic strategy, or they want to do the reverse and say, look, there's really uncertainty later in the year because the possibility of recession remains pretty significant, certainly well above average, and they feel more confident giving guidance in the next quarter. So you've got two arguments on both sides of that. That's a big discussion. Should they widen those ranges? Should, in fact, managements give two different sets of guidance, a scenario under which you have a recession and a scenario in which you have an economy continue to grow? Way you think about that is that earnings traditionally in a recessionary environment go down by around 10% or so. And that would obviously be, in addition to having a multiple contraction as well. But that's sort of, route one and route two, if you will. The different alternative path is that you have the economy continue to grow. And our baseline assumption is that you'll get earnings growth of around 3% this year and earnings per share growing around 6% next year. And as you know, what the market prices ultimately is the forward year earnings. And so this year's return to the stock market will be a function of next year's earnings growth. And we have expecting the economy to continue to grow into the next year. That's really where the discussions are. And where is it that portfolio managers should be positioning? We're looking for companies where there's relatively high degree of less variability, less amplitude in their earnings growth. And so a lot of consumer staples companies are fitting into that camp. Yes, they're a little bit expensive, but from an uncertainty point of view, that, in our suggestion, would be an area of focus on for outperformance in the coming 6 months.